While West Coast drivers saw gas prices slip a few pennies this week, they soared as much as 50 cents overnight in 5 Midwestern states after a partial shutdown at a huge BP refinery in Indiana. Joining us now, Barron's.com editor Jack Otter. Jack, one refinery shuts down and prices spike?
Well, this is the biggest refinery in the Midwest. For example, it supplies about 30% of Chicago's gasoline. So when this incident happened, refining capacity is very tight. So that reduced supply. Traders immediately bid up the cost of spot gasoline.
Okay, but oil prices have been crashing, I think down 35% since May. So how are prices going up at all?
So there's two different factors here. Locally, you've got this bottleneck in the final product, the refined gasoline. Meanwhile, the entire globe is awash in crude oil. And that's the number one factor is in the U.S., this fracking revolution. We now supply more oil than Saudi Arabia. On the other hand, demand is not very strong. China is slowing. The global economy's in the doldrums. Throw in a few efficiency improvements, and suddenly you've got a lot more oil than you've got demand for oil. That's pushing prices down.
Okay, now you're reporting at Barron's that you could see oil down to $20 a barrel. Are we going to see $1 a gallon gas at the pumps again?
Probably not. If it does hit $20, that would be a very brief phenomenon. It would be a huge deal in the trading pits, not so much at the pump. We would see an average over that low month of maybe $40, $35. So yes, you'd see a drop, but it wouldn't be that dramatic. Meanwhile, in your 401k and your retirement account, all of this low price is killing the oil companies. That's weighing down the stock market.
All right, Jack Otter, thank you.
My pleasure.